This is InvestTalk, independent thinking, shared success.
I'd love to get your opinion on General Mills, stock symbol GIS. Wanted to get your opinion, see if you thought it was a good long-term hold, and see what you thought a good entry point would be. Thanks.
All right, looking at General Mills, and this is a name that's been really down on its luck. It peaked out around $90 per share in mid-2023. So about 2 years ago is when it peaked out. And now we're at $54 per share. So quite the drop, about 40% drop from its all-time high. And this is what you would imagine would be a blue chip name, General Mills. Think of all the cereals that you've bought throughout the years, the specialty foods, the yogurts, the doughs, all of those tried and true names like Nature Valley and Cheerios and Old El Paso, Pillsbury, Betty Crocker, etc., Haagen-Dazs. This is all General Mills. The issue is that more and more people are pivoting their purchases to what we call the outside of the stores, right? Either the freezer section or the fresh produce section. So, history says, or the recent history says that the demand shift by the consumer is dramatic. And you can see that in their free cash flow, their profitability. It peaked out in 2021, free cash flow about $3.2 billion, and it hit a recent low around $2 billion. It has perked up to about $2.5 billion, but still in a longer term downtrend. And that is the issue. Earnings were $3.94 in 2022. Earnings have continued to go up over the past couple of years, but this year earnings are finally expected to drop 7% this year and 4% next year. So what they were doing with that cash flow is they were buying back shares, which typically is a good thing to do, good allocation of capital, as long as your stock is relatively cheap. And, General Mills doesn't trade at a high premium, typically, at least lately. Its current P ratio is 12, for example. So that typically is a good thing. But what that often does is it hides the underlying deterioration in its business. Because what happens is the share count drops and they're able to manufacture earnings per share growth, even when underlying net income is falling, for example. And total net income fell from $2.9 billion in 2022, and now it's at $2.55 billion. So while earnings per share has gone up, the total profits has declined. And that's the worry here. And with the amount of debt that they have about $14 billion in debt. Now, I don't think they're in a risk of cutting that dividend in the short term, but I don't like the demand trends for these traditional packaged food companies. And that's why I think you are kind of chasing a value trap. And I would be very patient with it. Last quarter, revenues were down 5%, earnings were down 15%. This upcoming quarter, revenues are supposed to be down 3%, earnings down 29%. So it's just not a good, they're not good trends here for the business. And until that turns around, I would absolutely pass on General Mills, GIS. Thanks for the call. Now, from time to time, we also receive InvestTalk questions from our comment section on the InvestTalk YouTube channel. So let's go answer one of those questions now. Hi guys, Brett from New Jersey here. I recently asked ChatGPT to randomly select some stocks with large upside potential. One of the three recommended APLD. Now, here's the first issue I have with this question is all he looked at was upside potential. That's not how you invest. If all you care about is upside potential, you go buy a bunch of penny stocks, right? Because though they have the most upside potential, they can double, triple, quadruple in a very short period of time. That's upside potential. But we know based on history, 99 out of 100 penny stocks, they stay penny stocks and they sit there for a long time and eventually they get delisted and you lose all your money. So the risk reward there is not very good. So what you should be asking, and not to say ChatGPT or any of the AI tools are going to do it well, is what's the best risk versus reward in the marketplace right now? The largest upside potential is not what you want. Okay. Now he's saying last Monday they announced the lease with CoreWeave for worth $7 billion. Now that is, if I look at the earnings expectations, it is helping earnings expectations for next year and the year after, but they're still supposed to lose money. Okay. So it moved up already. It's discounted that. What else is next? Okay. He says at one point I was up over 100%, currently up around 90. This was a tiny percentage of my portfolio, which I tend to take higher risks with. Can you look into this company? Let me know if it's something I should hold on to, buy more, or trim. Well, like I said, it's still losing money. And let's see, what does it do here? It's a $2.8 billion at a market cap after it did move from about $4 in, when was this? May, to $12 now. So he's obviously up a lot. They operate next-gen data centers, computer power to blockchain infrastructure, and support Bitcoin mining. Okay, so this is very Bitcoin and crypto adjacent, and it's going to move with Bitcoin price and crypto prices. And crypto prices tend to move with liquidity. Liquidity is good in the marketplace, then Bitcoin and crypto tends to do well. So this is basically a proxy bet, a leverage bet on Bitcoin and crypto. If that's what you're looking for, then this would be the name that you want to buy, right? And you kind of throw out the fact that it loses money because it's generally going to have a high correlation and high leverage to the Bitcoin price. And if that's what that's all speculation. That's not an investment. This is a speculative vehicle, similar to a MicroStrategy, right? It's not an investment. It's a speculative vehicle. And there's different levels of risk when it comes to crypto and Bitcoin. And you need to understand that, right? IBIT is just Bitcoin price. And that's very unlevered, single, one for one movement, percentage wise with Bitcoin. And so it depends on what type of risk you are willing to take. If Bitcoin, I've said this before recently, if Bitcoin breaks 100,000, it kind of invalidates its bullish trend right now. And you could see Bitcoin go back down to sub 50,000, and this would probably plunge to $2, right? Or maybe less. So that all depends. Is Bitcoin and crypto, or is that universe staying in a bullish pattern right now for the short term? It is, but once again, it can change rather quickly, and you need to be aware of that.
Hi, Justin. I'm calling today about the home builders. I'm curious how you guys feel about that sector right now. I'm looking specifically at Tri Pointe Homes, TPH. I used to own this company along with Pulte Group, PHM, and I did sell out of it. I have some cash on the sidelines. I was thinking about dipping my toes in now if you think now is the right time and they are undervalued. And I'm thinking maybe if and when the interest rates go down a little bit, there will be high demand. It may take, 6 months, maybe a year, maybe even longer. But I'm wondering if I start dipping my toes in now. The sector right now is, I think, a little hated. If you think that'll do well, I think Tri Pointe Homes, looking at the chart, is a little bit better. It looks like it hit some pretty good support. And if you could let me know how you feel about these companies. Thank you. Have a great day. Bye.
Yeah, I will say that the charts on both Tri Pointe and Pulte are starting to improve a bit. Now, that it could be very short-lived. I do think that we are entering a housing market that is a lot more balanced, at least in the short term. I'm seeing, inventories rise, not to levels. There's all these doom and gloomers. I see these on YouTube all the time. All these people that are calling for an '08 crash, and they've been doing it for years. And they have no idea what they're talking about. But a lot of people watch them. They get a lot of views. They get hundreds of thousands of views. And all of these people think there's going to be an imminent housing market crash. And the simple fact is there's just not the forced sellers out there that will cause that. Now, could it build and could we get there into a really, really bad market where there's just a ton of excess inventory across the country? At some point in the next 5 years, sure, but it's not now, right? But there are parts of the country, Austin, Texas is a good example. I think there's areas like Utah that are pretty overvalued and have excess inventory. So there are pockets, and that's certainly true. And there's issues with Florida and some of the insurance issues down there. But largely, there's a demographic demand that is really, I think, holding up the housing market in the shorter term. We call it the next few years, and that is the millennial generation. Millennial generation peak first-time home buyer age is right now, between now and 2028. And so until after that, then you can maybe see demand trailing off. But right now, you're also not seeing a lot of new supply coming on market, especially the existing home market. People are locked into 3% mortgages. They're not giving those up. So not to say that things can't get bad in the future, but it's just interesting the last 3-4 years, everyone's talking about a huge crash and it hasn't happened. But now we're back into a more balanced market. But until I feel more confident in the labor direction, because I think the market's a bit off on where the labor market has headed over the past month. I'm seeing a lot more deterioration than anyone's really talking about. So I think that's one issue. And there is, over the medium term, a dearth of new supply, and the home builders have been a big factor in fulfilling that lack of supply. Now, as the market becomes more balanced, I'm more neutral on these names. And so I would be patient despite the charts looking up in the short term. If you're looking for a short-term trade, a month or two, I could see that. I could see these rallying 10, 15, 20%. But to say this is entering some new longer-term uptrend, I would be reticent to predict that. So it depends on if it's a trade or it's long-term. As a trade, yes. As a long-term hold from these levels, I'm just not buying it quite yet. Until I think you want to buy these and really own these, probably coming out of the next recession. And I'm sure we'll get one in the next few years. Now let's keep things moving and play another listener question from 888-99-CHART.
Hi, I love the show. I was calling about S&P Global, SPGI. Just wanted to know what you think of it. If it's worth buying for the long term. Thank you. I'll be listening on the show.
All right. Looking at S&P Global, most people know this from the S&P 500, and they make fees from ETFs and index funds that track the S&P and other SP 500, as well as other S&P indices. And so they make money off that, but they also make money by rating bonds. And one reason why their earnings continue to go up is money's flowing into these index funds continuously, as well as you're actually going into a refinancing cycle on the bond market, corporate bond market, especially later this year and into next year in a big, big way. And they'll obviously earn fees by rating these issues. However, it is trading at expensive levels, 32 times current earnings. Even if you go based on forward-looking earnings of nearly $19 per share, you're still in the high 20s multiple, which is not cheap. Now, it's a great business. Return equity is actually, it's not that amazing, 10%. That's good. Let me see. It's been on decline. I don't love that. So, yeah, it's profitable, but not gangbusters. Its enterprise value is $172 billion, and its free cash flow is $5.5 billion. That's not a great free cash flow yield. I don't love that. Enterprise value to EBITDA right now is around 25, and its 5-year range, it's about in the middle of its 5-year range. So I don't see that as being particularly cheap. Price to sales is at 11. I rarely like those companies that trade at north of 10 on a price to sales ratio. This typically bottoms out closer to 8 or 9 times sales. So, it's a fine business. I just worry about that, the ebb and flow of the rating side. And then, will money flowing out of, say, the S&P 500 overseas, that could hurt total assets in index funds over time as well, especially the S&P, more diversity, maybe more global indices. MSCI is one of those type of names that tends to own more global indices or put out more global indices, and more products are tracked to the MSCI when it comes to global markets. So I think there could be money there. And the technicals are just okay. They're neutral. It's kind of hanging around. It's a flat 200 and 100-day moving average. And it's just kind of hanging around there. So I just don't see this as a great risk versus reward right now. I think at some point it could get cheap. If this gets down, say sub $400 per share, right now it's at $513. That's where I might pick it up. But until it gets below there, I would keep it on the watch list. It wouldn't be a name that I'm picking up right this moment. Now let's touch a bit on China. And we know that the trade war it has calmed down a bit, but still 30% on Chinese made goods is still Smoot Hawley-like, let's just say that. And then you have 10% elsewhere to kind of cover what a lot of companies are doing, which is moving their products from China, not completely finished, and then in another country, finishing the last 5 to 10% of the product, and then shipping it to the United States. And it now comes not from China, but from that other country. You've seen that with, during the height of the trade war, not long ago, a couple months ago, there were Chinese factories that were saying, hey, we're making Birkin bags. We're making all of these very high-end designer products, and they ship them 90% completed over to Italy, and they put a zipper on it. And now suddenly it's made in Italy, and now it's exported to the United States, for example. So a lot of companies are doing that. That's why they're keeping the 10% on. It's still impacting the Chinese business and their export business, but not as deeply as was first feared. Now, according to customs data, China exports to the US was down 34.5% year over year in May in value terms. So, if you get a 30% charge or 100% charge or whatever that tariff is at the time, the higher price that product is, the bigger the tariff. Now, what's happening as well is they're doing things like charging separately for maybe design services or something that's not part of the product, and then making the product value lower. So it might have, before it was being imported for $30. Now they charge some of that as a design service or some other type of service. And now they export it at $20. And net, it's about the same price. So that's part of this as well, because it's that 34.5% is in value terms. So how much of that is raw products not being shipped? And how much of that is the products just quote unquote dropping in value? So that's interesting as well. Total exports from the Asian giant expanded 4.8% year on year in value terms last month. That's total exports. Okay, so it still was up year over year because a lot of those goods, once again, were just being shipped to another country, or maybe they gave deals to Europe and Russia and South America to kind of keep the factories going. Now, Reuters was expecting the growth to be about 5%, so it missed that a little bit, but it is still down from the high in April of 8.1%. Okay, so down from 8.1 to 4.8. So it is having an impact in value terms. Imports did drop 3.4% year over year. So clearly they're not bringing as much materials and widgets in to put more products together. So that is deepening. Exports had surged 12.4% year over year and 8.1% in March and in April. So that's where they rush shipments to the US and other countries. And then China's imports from the US, from the United States, that was down 18.1% in May from a 13.8% drop in April. So it fell 13.8% year over year in April and down 18.1% in May. So it's really hurting our companies because they're just looking elsewhere. And they don't want to deal with the reciprocal tariff, right? Now they have a reciprocal tariff on us. So it now makes our products less competitive to China. And their trade surplus in May continues to grow to 103 billion from 96 billion the previous month. So this is the data here. It's not really kneecapping the Chinese economy. They're putting in stimulus measures, and it's something they're dealing with. But from this, if you go based on this data, it's actually hurting U.S. companies more than it is Chinese companies. Now let's roll in another quick question.
Hi, Luke and Justin. Longtime caller here from the Midwest. Love your show. Thank you much for everything. Hey, I have a quick question. I've had a company, CSL as a ticker symbol for quite a while. It's been in a slump lately, and I don't know if Carlisle is going to do anything here for a while or not, because I don't know. I'm nervous with interest rates and everything about housing and what's going to happen here in our future. Do you think that'd be a good one to sell? And what I'm looking at is ITW. I've heard you say many good things about that company in the past, its consistency and so forth. Would that be a good purchase to make in the future for a long-term hold? Thank you so much. Look forward to hearing your response on the show. Have a good day.
Are we looking at Carlisle companies? CSL is a symbol, about $16 billion market cap. And it manufactures and sells single-ply roofing products. And it has two segments: construction materials and weatherproofing technologies. And it mainly is for the commercial building industry. And I don't know if you noticed, but right now, in the United States, we're actually tearing down more office buildings than we're building. So that's one issue here. And if you look at its earnings, let's see, it's flat, expected to be up about 9% this year, 13% next year. That's okay. But last quarter, revenues were flat, earnings were down 3%. So I don't know where they're going to get to this 9% earnings growth. It doesn't pencil out for me. And the free cash flow is $758 million. That is down. Let's look at the peak. Yeah, it's down from about $1 billion. So, free cash flow is down about 25% over the past couple of years. That's one issue that I have. Now, they're keeping earnings per share going up because they're buying back stock. So, the underlying business is certainly deteriorating to a degree, and that's why you're getting this declining a bit. So I don't mind it. I think it's a solid business. I just don't love the backdrop because of the commercial real estate exposure there. But I do like the balance sheet. I do like the return on equity on 47%. I like the free cash flow, even though it's come down. That dividend of 1% can certainly go up. They have plenty of room to raise that with a dividend pay or cash dividend payout ratio of only 23%. So there's some things to really like about this business. And then you asked about Illinois Toolworks. And historically, this is a good business that usually can go in, and what they do is they buy up a lot of smaller machine tooling shops and that serve the automotive industry, construction industry, appliance markets, etc. And they've done a good job of allocating capital. Let's just say that. The problem now is that their growth is very slow. Revenues up 1%, earnings up 7%. Estimates for this year and next year are coming down as well. So from a timing perspective, I wouldn't say Illinois Toolworks would be the one I would pivot into. It would keep it on my watch list along with Carlisle Group. But if I'm picking one or the other, I'd probably say Carlisle Group because of that better valuation and better technicals for sure than Illinois Toolworks. So for now, I would probably not own either. Thanks for the call.
I was trying to contact you guys about the following ticker symbol, ARE. I had an alert for this on my account, and I'm just trying to see, is this a good time to consider getting into this? I would appreciate your analysis. Enjoy the show, and I hope you guys have a great day. Thank you.
All right, looking at ARE, which is Alexandria Real Estate Equities. And this is a REIT, Real Estate Investment Trust, and it invests in life science properties, okay, and urban office real estate. Okay, so mainly ag tech, technology, life sciences, like I said, mainly in high cost areas. So Boston, San Francisco, Bay Area, New York City, San Diego, Seattle, Maryland, the Research Triangle in Texas, and Canada. So clearly they're in high cost areas, but to acquire all of those properties, they took on a lot of debt. Market cap now is 12 billion. They have about 13 billion in long-term debt, and that continues to move higher and higher each year. And that's because their payout ratio is very high, 632%. So that 7% yield looks juicy, but their profitability is very poor. And it peaked back in 2021 when life science companies were easy to fund, when technology companies were raising capital very easily, and their occupation rate was probably very, very high. But ever since, it's been struggling. And if you look at its free cash flow, it peaked in 2024 by 1.6 billion. Now we're down to 1.37 billion. And clearly they're having issues with pricing, with tenants, and defaults. And that's why this is in a strong downtrend. And this is a perfect example of why you don't want to just look at the dividend, and you really want to trust that chart in a big way. When a chart is in a strong downtrend, which this has basically been in for, let's see, it peaked out back in December of 2021, kind of when the NASDAQ peaked out, and it was around $20 per share. Now it's all the way down to 73. So it might look cheap, but the market is telling you something. And I don't like these type of businesses. I don't like these. I don't like lending to these businesses because a lot of these, especially the life science, biotech names, they are money losers. Say that. They tend to burn capital. They sell the dream. They're historically the Ponzi stocks that have been around for decades, selling the dream of the next cure for cancer or whatever disease they're attacking. And when the cost of capital goes up, well, it's a lot harder for them to raise money. Same with tech space. I'm sure a lot of their tenants are in like private equity companies. And suddenly they're required to maybe work from home. Like the tech space, a lot of them are working from home. So leases come up. They signed them in 2021, 5-year lease. Well, next year they're up, and what are they're likely to do? They're likely to jump ship, downsize. No need for all that space. And that, I think, is what the market is pricing in, is how many people want to live in these big cities and go into an office? The office market is continuing to struggle, especially these high cost areas. Nobody wants to pay those prices. Those premium prices to work in, have an office in a big city where everyone has to live there and commute. No, that's not the way of the world today. And so that's why you have to align up the trends of the sector and put them in your favor. They need to be a tailwind to your investment thesis, not a headwind. And for this, the world has just shifted, and that's why it remains a headwind for the stock price as well as the overall business. So I'm passing on ARE. Well, that about does it. I'm Justin Klein. It's another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, Google Play. Be sure to rate and review on iTunes as well. And if anything on today's show piqued your interest and made you think about your own financial picture, your investments, maybe your taxes, retirement in general, sure we had a lot of discussion there, I encourage you to reach out to us at KPP Financial, where we offer a free portfolio review, as well as helping you get your arms around your financial picture, your retirement plan. Not just for a snapshot of today, but what happens in 10, 15, 20, and 30 years down the line. So head over to investtalk.com and click on the portfolio review button. Independent thinking, shared success. This is InvestTalk. Good night.